Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello everyone. So today let's look at the amendments for CA Final under the FEMA Act. Let's start. So there were these new rules and regulations which were introduced: foreign exchange management, overseas investment rules, and overseas investment regulations. So these were notified, they were published as on notification which came on August 22nd, 2022. Now, talking about overseas investment, the investment which is done by a resident here outside India is called as overseas investment. What happens is when someone from a foreign country is making investment here in India, it is either called as foreign direct investment or foreign portfolio investment. However, when we are making investment outside India, say a resident of India is making investment outside India, then that is called as an overseas investment. So these rules and regulations which we are going to study about now are related to overseas investment. Let's first look at a few important definitions and then we'll go to the rules and regulations. So the first important definition here which comes up is the meaning of the term control. So control means right to appoint majority of the directors or to control management, or policy decisions exercisable by a person or persons who is acting either individually or in concern directly or indirectly. It also includes by way of their shareholding or management rights of or shareholders agreements or voting agreements that entire them to 10% or more of the voting rights in any manner. So control here does not mean more than 50% voting rights. It here also includes people who have 10% or more than 10% of the voting rights in any other manner in any entity, or it also means the right to appoint majority of directors, or it also includes right to control the management. Now moving ahead, meaning of financial commitment. So financial commitment, it is basically the aggregate of the investment which is made by a person who is resident in India. So financial commitment is aggregate amount of investment. Who makes this? It is a person resident in India who's making this investment by way of overseas direct investment, debt other than overseas portfolio investment in a foreign entity or entities in which the overseas direct investment is made, and shall include the non-fund based facilities extended by such person to or on behalf of such foreign entities. So there are two types of investment. One is financial commitment and the other is overseas investment. When we talk about financial commitment includes overseas direct investment except or excluding those made as overseas portfolio investment. It also includes any non-fund based facilities which have been extended, and it also includes any other overseas investments which have been made. So everything apart from or debt other than the overseas portfolio investment is covered here under financial commitment. So what is financial commitment? It is an aggregate amount of investment which is made by a person resident in India. Then comes financial service regulator. So financial service regulator means a person, an entity which is established under law. Now, who are financial service regulator? It includes the Reserve Bank of India. It includes Securities and Exchange Board of India, SEBI. It includes Insurance Regulatory Development Authority. There's Pension Fund Regulatory and Development Authority. So these are the financial service regulators which have been notified or which have been established under the law. Now talking about what is a foreign entity. So foreign entity means entity which is formed or which is registered or incorporated outside India. It also includes IFSCs and an entity which has limited liability. However, there's a proviso to it which says that this restriction of limited liability The definition of foreign entity itself says that it is an entity which is formed or registered or incorporated outside India and has limited liability. However, this restriction of limited liability will not apply where the core activity of the foreign entity is in a strategic sector. Now, what does a strategic sector mean? Strategic sector could include natural resources, and we'll look at the definition of strategic sector ahead. So what is a foreign entity? Entity incorporated outside India and which has limited liability. However, this restriction of limited liability will not apply where the core activity of the entity is in any strategic sector. What is an Indian entity? Indian entity means a company defined under the Companies Act, a body corporate incorporated by any law, LLP duly formed and incorporated under LLP Act, and partnership firm which is registered under the Partnership Act 1932. So these are the entities which are included in the definition of Indian entity. Then comes another important definition, and that is the definition of overseas direct investment, or it is also called as ODI. Means investment by way of acquisition of unlisted equity capital of a foreign entity. So what is the first point here? It is acquisition of unlisted equity capital of a foreign entity or it also includes subscription as a part of the memorandum of association of the foreign entity, or investment in 10% or more of the paid up equity capital of a listed foreign entity, or investment with control where investment is less than 10% of the paid up equity capital of a listed foreign entity. So overseas direct investment includes three things. One is acquisition of unlisted equity capital of foreign entity, subscription as a part of the memorandum of association of the foreign entity, or investment in 10% or more of the equity of the paid up equity share capital of the foreign entity. And which type of foreign entity? Listed foreign entity. Now talking about what is overseas investment, it means financial commitment and overseas portfolio investment by a person resident in India. So what is overseas investment? It means financial commitment and overseas portfolio investment, which is made by whom? It is made by person resident in India. Then comes overseas portfolio investment. It means investment other than ODI, that is overseas direct investment, in foreign securities, but not in any unlisted debt instrument. It does not include any investment which is made in debt instrument which are unlisted, or any security issued by a person resident in India who is not an IFSC. So overseas portfolio investment means an investment which is not overseas direct investment. It is an investment in foreign securities, but not in unlisted debt instruments, or any security which is issued by a person resident in India who is not an IFSC. Provided that OPI by a person resident in India in the equity capital of a listed entity, even after its delisting shall continue to be treated as OPI. Even if the listed entity has become unlisted, the investment which is made will be treated as OPI until any further investment is made in that entity. So until any further investment is made, the investment will still be considered as an OPI, though the entity is no longer listed. So these were a few important definitions. The remaining definitions are simple ones and not very important. Subsidiary, let's look at one or two more definition. Subsidiary, it is a subsidiary of a foreign entity means an entity in which foreign entity has control. And what is control? We have understood what control is in the first definition which we saw. Now talking about strategic sector, it includes energy and natural resources sectors such as oil, gas, coal, mineral ores, submarine cable system, and startup, and any other sector and subsector as is deemed necessary by the central government. So strategic sector, it includes energy and natural resources. Now, these are the rules. FEMA oversees investment rules. Who will administer, who will take care of administration of these rules? So it is the Reserve Bank which will take care of administration of these rules. And the Reserve Bank from time to time may issue directions, circulars, instructions, and clarifications as it may feel necessary. Moving on, non-applicability of rules and regulations in certain situations. So what are the cases wherein these rules and regulations will not apply? So any investment made outside India by financial institution in an IFSC. So the first case wherein these rules and regulations will not be applicable is where the investment is made outside India by any financial institution in a IFSC. So if an investment is made by a financial institution outside India in IFSC, it will not be treated, these rules will not be applicable there. Second is acquisition or transfer of any investment outside India made out of resident foreign currency account, that is RFC account, out of foreign currency resources held outside India by a person who is employed in India for a specific duration irrespective of the length thereof, or for a specific job or assignment duration of which does not exceed 3 years. So if the acquisition or transfer which is done is made outside India, of any investment which is made outside India is made out of foreign currency resources which is held outside India by a person who is employed in India for a specific time duration, and this time duration does not exceed 3 years, then that is also a situation wherein these rules will not apply. We are talking about non-applicability cases. First is where investment is made outside India by financial institution in an IFSC. Second situation talks about acquisition or transfer of any investment which is outside India. And if that acquisition or transfer is done either by the proceeds of RFC account or out of any foreign currency resources which are held by that person outside India, then in that situation also it will not be treated as these rules and regulations will not be applied there. And then in accordance with subsection 4 of section 6 of the Act, you all know what subsection 4, section 6 subsection 4 is. Then they've given us the classification of debt instruments and non-debt instruments. So what are debt instruments? Government bonds, corporate bonds, all tranches of securitization structure which are not equity tranche, borrowings by firm through loans, and depository receipts whose underlying securities are debt securities. So these are all debt instruments. Now talking about non-debt instrument. All investment in equity is in incorporated entities, capital participation and limited liability partnerships, all instruments of investment as recognized in the foreign direct investment policy from time to time. So all the instruments of investment will fall under this particular non-debt instrument criteria. Non-debt instruments also include investment in unit of alternate investment fund and real estate investment trust, REITs and InvITs, investment in units of mutual funds and exchange, the junior most layer of securitization structure, acquisition, sale or dealing directly in immovable property, contribution to trusts, and depository receipts issued against equity instruments. So all of these are non-debt instruments. Then talking about continuity of certain investment. So any investment or financial commitment outside India made in accordance with the Act's rules and regulations and made thereunder and held as on the date of publication of these rules in the official gazette shall be deemed to have been made under these rules and regulations. So any investment or financial commitment which is made outside India in accordance with the Act's rules and regulations, it shall be held as on the date of publication, that it shall be deemed that these rules and regulations have been complied with whenever that investment or financial commitment was made. Then comes rights issue and bonus shares. So any person who is a resident in India, who has acquired and continues to hold equity capital of any foreign entity in accordance with the provisions of these acts and rules, then they may invest in equity capital issued by such entities as rights issue, or may be granted bonus shares subject to terms and conditions, or the person resident in India acquiring rights may renounce such rights in favor of the person resident in India or resident outside India. Talking about prohibition on investment outside India, no person who is resident in India, he shall make or transfer any investment or financial commitment outside India. So a person who is a resident in India, he shall make or transfer any investment or financial commitment outside India. He should not be doing that. Let's now look at overseas investment regulation rules related to overseas investments. So it basically says any investment made outside India by whom? By a person resident in India shall be made in a foreign entity which is engaged in a bona fide business activity. So what is the first point here? It has to be made, the investment has to be made in a foreign entity which has a bona fide business activity. Bona fide means genuine. Bona fide business activity directly or through step down subsidiary or the special purpose vehicle subject to the limits and conditions laid down in these rules and regulations. There's a provision which says the structure of such subsidiary or steps down subsidiary shall comply with the structural requirements which have been given of that foreign entity. There's a further provision which says that overseas investment or transfer of such investment, including swap of securities in a foreign entity, may be advised by the central government from time to time and shall require prior approval of the central government. So in case of any swap of securities, then in case of that foreign entity which is being formed, it has to happen after prior approval of the central government. Now, what is bona fide business activity? It means any permissible business which is being carried on, permissible under law force in India and also the host country. Now, there's a notwithstanding provision which says that the central government may, on an application made to it through the Reserve Bank, so Reserve Bank is making an application to the central government, permit financial commitment in strategic sectors above the limits laid down in these rules and subject to such terms and conditions as it considers necessary. So the central government, if an application is made to it by Reserve Bank, it may permit financial commitment in strategic sectors above the limits which have been laid down. The Reserve Bank may, on an application made to it by the designated AD bank, and for sufficient reasons, permit a person resident in India to make or transfer any investment or financial commitment outside India, subject to the satisfaction of those conditions. There's another proviso which says that the overseas investment which is made by a person resident in India, it shall not be made in a foreign entity which is located in a country or jurisdiction as may be decided by central government from time to time. So the central government may notify certain jurisdiction, certain localities where the overseas investment shall not be permitted or may not be permitted, and those overseas investments shall not be made. The Reserve Bank, if it considers necessary, may in consultation with the central government stipulate the ceiling for the aggregate outflows during financial year, and also beyond, they may also stipulate a ceiling beyond which the amount of financial commitment by a person resident in India shall require prior approval. So they may put a ceiling limit to the aggregate amount of outflows which are happening during a financial year on account of financial commitment and or any overseas portfolio investment, and not only aggregate outflows, but they can also put a limit on the amount of financial commitment which is being made by a PRI in a financial year, that after so and so amount you will have to take permission, you will have to first take approval, and only then you can make a financial commitment of that particular amount. Now a no objection certificate has to be obtained by whom? So any person resident in India who has an account which appears as a non-performing asset, that is NPA, or who is classified as a willful defaulter by any bank, or who is under investigation by any financial service regulator or by any other investigative agencies in India, such as CBI or any enforcement directorate or serious fraud investment office, then in that situation, this person, that is this person resident in India, will have to obtain a no objection certificate from the lender bank or the regulatory body or the investigating agency by making an application in writing. So he has to make an application in writing asking these bodies, depending on whether he's an NP or willful defaulter or is under investigation. So depending on the situation, he'll have to first make a written application to the regulatory body or the bank or the investigating agency, asking them to give him a no objection certificate for the purpose of making any financial commitment or overseas investment. However, say this letter has been given, this application has been made by this person resident in India, and there's no response to this application which has been made within 60 days by these bodies. Then if there's no response which has been received, then it shall be deemed, it will be presumed that there's no objection which they have. If they have an objection, they would have responded within 60 days. Since no response has been received, it shall be presumed that these authorities do not have any objection. Now, manner of making overseas direct investment by Indian entity has to be done as per Schedule 1. Overseas portfolio investment by Indian entity as per Schedule 2. Overseas investment by a resident individual as per Schedule 3. Overseas investment by a person resident in India other than Indian entity and resident individual in Schedule 4. And overseas investment in IFSC by person resident in India has been specified in Schedule 5. So there are 5 schedules wherein all of these investments, how the investment has to be made, has been specified. Now talking about the pricing guidelines. So it basically says that the issue or transfer of equity capital of a foreign entity from a person resident outside India or a person resident in India to a person resident in India who is eligible to make such investment, or from a person resident in India to a person resident outside India, shall be subject to the price arrived on arm's length basis. So it basically talks about the concept of arm's length price. So any issue or transfer of equity capital of a foreign entity which is being happening has to happen at arm's length price. Whether it is happening between a person resident outside India or a person resident in India to another person resident in India, or from a person resident in India to a person resident outside India, everything has to happen on an arm's length basis. The AD bank, before facilitating a transaction, shall ensure compliance with the arm's length pricing. The bank shall first ensure that the compliance with the arm's length pricing has been done. Now talking about transfer or liquidation. So a person resident in India who's holding equity capital may transfer such investment in compliance with the limits and subject to the conditions of such investment and disinvestment. So if there's a person resident in India and he's holding such overseas investment, he can transfer such investment. However, this transfer has to be in compliance with the regulations, rules and regulations which have been made. A person resident in India may transfer equity capital by way of sale to a person resident in India who is eligible to make such investment under these rules, or to a person resident outside India. So a person resident in India, to whom can he make the transfer? He can make the transfer to another person resident in India or to a person resident outside India. But this person resident in India should be an eligible person, eligible to make such investment under such rules. In case the transfer is on account of merger, amalgamation, demerger, or due to buyback of foreign securities, then such transfer or liquidation shall have the approval of the competent authorities as per the applicable laws in India or the laws of the host country or the host jurisdiction. And then whether disinvestment by a person resident in India pertains to ODI when it relates to overseas direct investment, then the transferor, in case of full disinvestment other than by way of liquidation, shall not have any dues outstanding for receipt which such transferor is entitled to receive from any foreign entity. So in case of full disinvestment, there shouldn't be any dues pending which the transferor is entitled to receive from the foreign entity. And the transferor in case of disinvestment must have stayed invested for at least 1 year from the date of making ODI. So for the purpose of disinvestment, he should have invested for at least 1 year. And the holding of any investment or transfer thereof shall not be permitted if the initial investment was not permitted under the Act. So transfer of investment or holding of investment shall not be permitted if the initial investment was not permitted under the Act. Then there's restructuring also, which happens. So a person resident in India who has made any overseas direct investment in any foreign entity, he may permit restructuring of the balance sheet of that foreign entity wherein he has made the investment. Or why restructuring? Say it is a foreign entity which is incurring losses for the previous 2 years as per its audited balance sheets. So what can he do? Let's see. So a person resident in India who has made ODI in a foreign entity may permit restructuring of the balance sheet of that foreign entity which has been incurring losses for the previous 2 years as per its audited books or audited balance sheet, subject to ensuring the compliance with. So he will permit this restructuring of balance sheet only after he ensures that the compliance of reporting, documentation requirements and other things have been done properly, and also subject to the diminution in the total value of the outstanding dues towards that person resident in India on account of the investment which he has made in equity and debt, and after such restructuring not exceeding the proportionate amount of the accumulated losses. So basically restructuring may be permitted by this person resident in India, but he'll permit restructuring only if he's satisfied that every compliance requirement has been done properly. And also provided that in case such diminution where the amount of corresponding original investment is more than 10 million US dollars, or in case where the diminution exceeds 20% of the total value of the outstanding dues towards the Indian entity or investor, the diminution shall be duly certified on arm's length basis by a registered valuer. Provided further that the certificate dated not more than 6 months from the date of transaction shall be submitted to the designated AD bank. What are some restrictions and prohibitions on ODI? So, a person resident in India shall not make overseas direct investment in foreign entity which is engaged in real estate, gambling, or which is dealing in financial products linked to the Indian rupee without any prior approval from the Reserve Bank of India. The second restriction is any ODI in startups recognized under laws of the host country, as the case may be, shall be made by an Indian entity only from the internal accruals, whether from the Indian entity or group or associate companies in India, and in case of resident individuals, from own funds of such individuals. So any ODI which is being made in any startup, it shall be made from internal accruals if it is being made by an Indian entity, and if it is a resident who is making it, then from his own funds. And no person resident in India shall make financial commitment in foreign entity that has invested or invests into India at the time of making such financial commitment or at any time thereafter, either directly or indirectly. However, there are certain situations wherein the restrictions will not apply. Okay, let's talk about the requirements to be specified by the Reserve Bank. The mode of payment, deferred payment of consideration, reporting, realization, and other requirements of the investment which is made outside India by person resident in India. Everything, all of this has to be as per the regulations which are made by the Reserve Bank of India. Then restriction on acquisition or transfer of immovable property outside India. Now, what are the restrictions on transfer or acquisition of immovable property? So, no person resident in India shall acquire or transfer any immovable property outside India without general or special permission of Reserve Bank. So, acquisition or transfer of immovable property cannot be done by a PRI unless it has obtained either general permission or special permission of Reserve Bank. However, this rule will not apply to property which is held by a person resident in India who is a national of a foreign state. If there's a person resident in India but he was a national of a foreign state, then in that situation this rule will not apply. Or this will not apply in a situation where the property has been acquired by a person resident in India on or before 8th of July 1947 and continued to hold it with the permission of RBI, or if it is acquired by a person resident in India on a lease not exceeding 5 years. So these are the situations wherein this restriction of special or general permission from RBI will not apply. However, the person can acquire property by way of inheritance or gift or purchase from person resident in India who has acquired such property as per the provisions of FEMA. A person resident in India may acquire immovable property from a person resident outside India by way of inheritance, purchase out of RFC account, by way of purchase out of remittances which are sent under the liberalized remittance scheme, jointly with a relative who is a person resident outside India, out of the income of sale proceeds of the income or sale proceeds of the assets other than overseas direct investment acquired overseas. An Indian entity having an office overseas may acquire immovable property outside India for business and residential purposes of its staff. Now, talking about the schedules. Schedules prescribe the manner in which overseas investment has to be made. So, what is the manner of making overseas direct investment by an Indian entity? So, the first thing is Indian entity may make ODI by way of investment in equity capital for the purpose of undertaking bona fide business activity, that is a genuine business activity, in the manner and subject to the limits and conditions which are provided in the schedule, that is this schedule 1. So what are the ways in which the overseas direct investment may be held? Let's see. It can be held either by way of a subscription to the memorandum of association or purchase of equity capital, listed or unlisted. Can be made either through acquisition through bidding or tender procedure, acquisition of equity capital by way of rights issue or allotment of bonus shares, capitalization within the time period of any amount which was due towards the Indian entity from the foreign entity, and the remittance of which is permitted under this act and does not require any permission of the central government or RBI. The swap of securities, merger, demerger, amalgamation, or any scheme of arrangement. So these are the ways in which an Indian entity can make investments. ODI. ODI in financial services activity. So an Indian entity which is engaged in any financial services activity can also make ODI in a foreign entity which is directly or indirectly engaged in financial services, subject to certain conditions. What are the conditions? Indian entity should have posted net profits during the preceding 3 financial years. Indian entity is registered with or regulated by financial service regulator in India. The next condition is Indian entity has obtained approval as may be required from the regulators of such financial services activities both in India as well as the host country. Then an Indian entity which is not engaged in financial services activity may make an overseas direct investment in a foreign entity which is directly or indirectly engaged in financial service activity except banking or insurance, subject to the condition that Indian entity should have posted net profits for the preceding 3 financial years. So even an Indian entity which is not engaged in financial services may make an ODI in a foreign entity which is engaged in financial services. However, one such condition is that it should have posted net profits for the preceding 3 financial years. If an Indian entity does not meet the net profit required, then the financial results of such period may be excluded for considering the profitability for the period of 3 years. Also, overseas investments which are made by banks and NBFs, non-banking financial institutions, which are regulated by the Reserve Bank, shall be subject to the conditions which are laid by the Reserve Bank. Now, what is the limit for financial commitment? The total financial commitment made by an Indian entity in all the foreign entities taken together aggregate the total limit at the time of undertaking such commitment shall not exceed 400% of its net worth. So it should not exceed 400% of the net worth as on the date of the last audited balance sheet. So the total financial commitment shall not include capitalization of retained earnings for reckoning such limits. So we will not include capitalization of retained earnings, but it shall include utilization of any amount which is raised by ADRs or GDRs, utilization of proceeds of external commercial borrowings, provided that the financial commitment made by Maharatna or Navratna or Mini Ratna or subsidiaries of such public sector undertakings in foreign entities engaged in strategic sector shall not be subject to limits which are laid down. So these limits will not be applicable in certain cases. Now talking about Schedule 2. So where the overseas portfolio investment is made by the Indian entity. So OPI by an Indian entity may make OPI which shall not exceed 50% of its net worth as on the date of its last audited balance sheet and subject to the conditions which are laid down. A listed Indian company may make OPI by way of reinvestment. Unlisted Indian entity may make OPI under clauses 3, 4, 5 and 6 of Schedule 1 as specified under Schedule 1. And Schedule 3 talks about how a resident individual will make overseas investment may by way of equity capital or OPI in a manner which is provided under Schedule 3 unless otherwise provided hereunder shall be subject to the overall ceiling under the liberalized remittance scheme which is given by the Reserve Bank. What are the ways in which a resident individual may make overseas investment? By way of ODI in an operating foreign entity not engaged in financial service activity, which does not have subsidiary or step down subsidiary where resident individual has control in the foreign entity. By way of OPI, by way of reinvestment, ODI and OPI as the case may be, by way of capitalization within the time period of any specified realization under the Act, swap of securities, acquisition of equity capital by way of rights issue, bonus shares, gift, inheritance, acquisition of sweat equity shares, acquisition of minimum qualification shares for holding a management post, acquisition of employee stock ownership plans, under the employee benefit scheme. So these are certain ways in which resident individual can make overseas investment. So a resident individual may, without any limit, acquire foreign inheritance. So there is no limit and holding such securities according to the provisions of the Act. And a resident individual can also acquire foreign securities by way of gift from a person resident outside India. However, this has to be subject to the provisions of FCRA, that is Foreign Contribution Regulation Act. So a resident individual who is employee or director of an office in India or branch of overseas entity or a subsidiary in India may acquire without any limit shares or interest under the employee stock ownership. This is similar to ESOP, or by way of sweat equity shares or under any employee benefit scheme by that overseas entity, provided that it has to be on a uniform basis, globally on a uniform basis. Then comes Schedule 4, wherein it talks of overseas investment by a person resident in India other than Indian entity and uh, resident individuals. So this basically talks about ODI by any trust, society. So they can also make overseas direct investment in a foreign entity, but this has to be done with prior approval of the Reserve Bank, subject to certain conditions. The foreign entity wherein the trust or the society they are investing has to be engaged in the same sector as that of the trust and the society which is making this for overseas investment. The trust or the society shall be in existence for at least 3 financial years before the year where the investment is being made. So there has to be a significant presence. The trust deed, the memorandum of bylaws shall permit the proposed ODI. Basically, the trust deed and the society bylaws should permit this. Then such investment have the approval of trustees in case of trust and the council and the managing committee in case of the society. In case of trust or society, they require special license or permission either from Ministry of Home Affairs or from the relevant local authority. Overseas investment can also be made by mutual funds or venture capital funds or alternate investment fund. So they have to do it as per the specifications specified by SEBI. They can acquire foreign securities, but again as per SEBI regulations in accordance with the provisions of SEBI Act. Now, any person being a SEBI approved clearing corporation from a stock exchange and its clearing members may acquire, hold, transfer foreign securities offered as collateral by foreign portfolio investors subject to the guidelines which have been issued by SEBI. One is open and maintain demat account for the foreign depositories, remit the proceeds which are arising due to such action, and liquidate such foreign securities and repatriate the funds back to India. What is being done? First thing, open demat account with the foreign depository, remit the proceeds during which are arising due to the transfer or acquisition which is being done, and once it is done, liquidate, that is liquidate the foreign securities, and whatever funds you get you will have to repatriate, that is send them back to the country, that is India. A domestic depository may also acquire foreign securities, however it has to be in accordance with the regulations. And if you remember, this can be done as per they issue Indian depository receipts. Just like GDRs and ADRs, we also have IDRs, which are Indian depository receipts. So overseas investment in IFSC by a person resident in India. So overseas investment in IFSC by a person resident in India, this can be made provided the rules are complied with. So a person resident in India may make overseas investment in IFSC as laid down in Schedule 1 or Schedule 2 or Schedule 3 or 4. However, in case of ODI made in an IFSC, the approval by financial service regulator concerned shall be decided within 45 days from the date of application, complete in all respects, failing which it shall be deemed to be approved. An Indian entity not engaged in financial services activities in India, making ODI in foreign entity, which is directly or indirectly engaged in financial services, except banking or insurance, who does not meet the net profit condition as required under this rules, may make ODI in IFSC. So we had that net profit conditions past 3 years. If that Indian entity does not meet it there, cannot invest in foreign entity engaged in financial services, but can invest in IFSC. A person resident in India may make contribution to an investment fund or vehicle set up in an IFSC or OPI. Resident individual may make ODI in foreign entity, including entity engaged in financial service activities, if such entity does not have subsidiary or step down subsidiary outside IFSC. Recognized stock exchange in the IFSC, it shall be treated as a recognized stock exchange outside India. Now talking about foreign exchange management, overseas investment regulations. So all that we were studying till now were rules. Let's now have a look at regulations. What are the other ways of making financial commitment? So Indian entity may lend or invest in any debt instrument issued by a foreign entity, or extend non-fund based commitment to or on behalf of the foreign entity, including overseas step down subsidies, subject to the conditions which have been prescribed. What are the limits, conditions for financial commitment limit? The Indian entity is eligible to make overseas direct investment, has made ODI in a foreign entity, has acquired control over such foreign entity at the time of making financial commitment, and financial commitment under regulations 4567 shall be reckoned towards the financial commitment under sub-regulation 1. Financial commitment by Indian entity by way of debt. So an Indian entity may lend or invest in any debt instruments issued by foreign entity, subject to the condition that such loans are duly backed by loan agreement. So these loans shall be backed by a loan agreement, where the rate of interest shall be charged at an arm's length basis. Financial commitment by way of guarantee. So the following guarantees may be issued on by or on to or on behalf of the foreign entity or any of its step down subsidiary in which Indian entity has acquired control. What are the types of guarantee? Corporate or performance guarantee by such Indian entity. Corporate or performance guarantee by group of company or by group company of such Indian entity in India, being a holding company or a subsidiary company or promoter group company, which is a body corporate. Personal guarantee by resident individual, promoter of the Indian entity. Bank guarantee, which is backed by counter guarantee of collateral by Indian entity. So these are the different guarantees which can be given. Where the guarantee is extended by a group company, so where a group company is giving guarantee, shall be counted towards the utilization of its financial commitment limit independently. So we saw that there's a limit to financial commitment, ceiling limit. So where a group company is giving guarantee, then that amount for the purpose of which it is giving guarantee will be counted in its financial commitment also, and this counting will be done independently. Provided that where the commitment is extended by group company and any fund-based exposure to or from the Indian entity shall be deducted from the net worth of the group company for computing its financial commitment limit. So this is basically for the calculation of financial commitment, limit of financial commitment. And where it is given by a promoter, which may be a body corporate, that Indian entity should be a part of that promoter group. And no guarantee has to be open-ended. The guarantee to the extent of the amount involved shall cease to be a part of non-fund based commitment and be considered as lending. Where a guarantee has been extended jointly and severally by two or more Indian entities, 100% shall be reckoned towards individual limits of each of the Indian entities. Say there are two Indian entities, A and B. The guarantee given is say 1 CR for 1 CR. So this 1 CR will be counted here as well as here separately in the financial commitment limit of both the Indian entities separately. In case of performance guarantee, 50% of the amount of guarantee shall be towards the financial commitment limit. Rollover guarantees shall not be treated as fresh financial commitment where the amount on account of such rollover does not exceed the amount of original guarantee. The other way of making a financial commitment is by creating a pledge or by creating a charge. They may pledge the equity capital of foreign entity in which the Indian entity has made overseas direct investment. They may create charge by way of mortgage, pledge, hypothecation or any other identical mode. On what? On the assets in India, including assets of group company or associate company, assets outside India or foreign entity in which the ODI has been made or its step down subsidiary in favor of the AD bank which is in India. Now, where a person resident in India acquires equity capital by way of where a person resident in India acquires equity capital by way of subscription to an issue or by way of purchase from a person resident outside India, or where a person resident outside India acquires equity capital by way of purchase from person resident in India, and where such equity capital is treated as ODI, then a payment of amount of consideration for the equity capital may be deferred for such definite period from the date of agreement as provided in the agreement. However, subject to conditions, following terms and conditions. What are they? The foreign securities equivalent to the amount of total consideration shall be transferred or issued upfront by the seller to the buyer. The full consideration shall be compliant with the applicable pricing guidelines. And the buyer may be indemnified by the seller up to the amount and subject to the terms and conditions as may be specified. Now, what will be the mode of payment when a person is making overseas investment? The mode of payment could either be by way of remittance through any banking bills, from funds held in accounts which are maintained as per the provisions of the Act, or by way of swap of securities, by using proceeds of ADRs or GDRs or any stock swaps or any external commercial borrowings, any such things. What are the obligations of a person resident in India? Who is acquiring any equity capital in foreign entity shall submit to the AD bank share certificates or any other relevant documents as per the host country's applicable laws, and as an evidence that he has made the investment, and this has to be done within 6 months from the date of effecting remittance or the date on which the dues are capitalized. A person resident in India through its designated AD bank shall obtain a unique identification number UIN from Reserve Bank for the foreign entity in which the ODI is intended to be made before sending any outward remittance. So a UIN has to be obtained, and they'll also have to designate an AD bank, and all the transactions should be routed through that AD bank and as per that, using that particular UIN. And where more than one person is making financial commitment in one foreign entity, then all persons should route their transaction relating to the UIN through the AD bank which is designated for that unique identification number. And when a person has an ODI in a foreign entity, he shall realize and repatriate to India all dues which are receivable from that foreign entity with respect to the investment which he has made in that entity, the amount of consideration which is received on account of transfer or disinvestment. Everything has to be done. Everything has to be repatriated. Say the NRV in case of liquidation of that foreign entity. And all of this has to be done within 90 days from the date where the receivables fall due, or the date of transfer or disinvestment or distribution of assets which is made by liquidator. So realization and repatriation of funds to India shall be made within a period of 90 days. And a person resident in India who is eligible to make ODI may make remittance towards earnest money deposit or obtain a bid bond guarantee from AD Bank for participation in bidding and tender procedure. Reporting requirements. All reporting shall be made through the AD Bank only and as specified by RBI. So whether it is a financial commitment which has been made or any disinvestment, both of these has to be reported by the person resident in India. Disinvestment has to be informed about within 30 days from the receipt of proceeds, or even in case of any restructuring, the information has to be made. Also, a person resident in India shall report such investment or transfer of investment within 60 days from the end of half year in which the investment or transfer is made as of September or March end. So this has to be made, the reporting of any investment or transfer has to be made within 60 days from the end of half year in which the investment or transfer is made. End of half year may either happen on September or March end. And in case they've obtained any employee benefits or employee stock ownership plans, then the reporting shall be done by the office in India of the branch of that overseas entity or subsidiary in India of that overseas entity. And a person resident in India who is acquiring equity capital in foreign entity, which we call as overseas ODI, he shall submit an APR, which is annual performance report, with respect to that foreign entity every year on 31st of December. And where the accounting year of such foreign entity ends on 31st December, then APR shall be submitted by the 31st December of next year. However, no reporting requirement shall be required where the person resident in India is holding less than 10% of the equity capital without any control in the foreign entity. We have understood in the first definition, controls means holding greater than 10%. And there's no financial commitment other than by way of equity capital or foreign entities under liquidation. तब भी नहीं करना पड़ेगा. And the annual performance report shall be based on the audited financial statements of that foreign entity. In case there's any delay in reporting, then there'll be a late submission fee which will have to be paid. Maximum period of 3 years from the due date is given. A person resident in India responsible for submitting evidence or any filing related to overseas investment shall, before the date of publication of these in the official gazette, and who is not made or does not make such submission of filing, he shall make the filing along with the late submission fee, and this late submission fee has to be as per the period of delay which has happened. Restriction of further financial commitment or transfer. A person resident in India who has made financial commitment in a foreign entity in accordance with the acts or rules or regulations shall not make any further financial commitment whether fund based or non-fund based, directly or indirectly, towards such foreign entity or transfer till any delay in reporting is regularized. So if there's any delay in reporting, first do the reporting, and only then the person shall be permitted to make another further financial commitment or transfer. So this was it with respect to FEMA amendments. Thank you, and for any doubts you can stay connected with us on forums. We are happy to help.